and welcome. Today, we're breaking down a major economic story that's quietly impacting your wallet, corporate profits, and the stock market. Tariffs and why research now suggests they cost the average American household about $1,000 last year alone. According to new research from the Tax Foundation, tariffs acted like a hidden consumer tax, adding roughly $1,000 per household in 2025, with projections rising to around $1,300 this year if policies stay in place. And here's the key takeaway for investors: tariffs don't just affect trade, they ripple through prices, margins, and stock performance. So, what do tariffs actually do to the economy? Tariffs are essentially taxes on imports, but most economists agree companies usually pass those costs directly to consumers through higher prices. That means higher costs for goods, pressure on consumer spending, margin pressure on companies that can't raise prices fast enough. And we're already seeing companies globally adjusting pricing strategies because tariffs are becoming a normal cost of doing business. So, just how does this impact the stock market? Tariffs tend to create three market effects. One, higher inflation pressure. Two, slower global trade growth. And three, sector winners and losers. Tariffs can also reduce export demand, which can slow growth across industrial sectors tied to global trade. Now to the impact on stocks. One in particular, Nvidia, depends heavily on global supply chains and overseas demand. Tariffs can increase component costs, raise data center hardware prices, and potentially slow international demand. But AI demand and enterprise spending can offset macro pressure, making Nvidia what some are calling a volatility stock. When it comes to tariffs and sensitivity, e-commerce stock Amazon has a high tariff sensitivity as well. Stocks like Amazon are exposed because many third-party sellers rely on imports, and consumer goods pricing directly impacts demand, tariffs, and historically has pushed retail prices higher. Retail is a low-margin business, meaning demand sensitivity matters. If consumers' budgets shrink, discretionary spending drops, and e-commerce growth slows. In some cases, retail essentials can also tend to become defensive winners tied into the tariffs impact. Some research shows that big box and grocery heavy retailers may actually because consumers are shifting towards essentials and discount channels. For example, Walmart. Walmart is showing bullish momentum right now as investors rotate into defensive growth stocks. The company continues to gain market share in groceries while expanding high margin business like advertising, memberships, and fintech. Plus, in uncertain economic conditions, investors often favor value leaders with stable cash flow. So here's the big picture and the market takeaway. Markets don't just move on tariffs, they move on expectations. Tariffs are no longer just political policy, they are earnings drivers, sector rotators, and macro catalysts. And if household costs continue rising, expect consumer behavior to be the biggest market signal to watch. If you want weekly breakdowns of macro policy and market impact, be sure to subscribe, follow, and comment below on what topics you would like us to explore next.